You set up an LLC and it's going to save you thousands, if not millions in taxes. Oh, did I hear that right? Matter of fact, you're not going to pay any taxes at all because you have that LLC set up. There are so many misconceptions out there on YouTube and social media. I am so tired of hearing people tell me that because they have their LLC set up, it's going to save them money on taxes. Newsflash, it's not going to save you any money on taxes. Because an LLC is not a tax election. It is for asset protection. In this video, I'm going to be teaching all of you business owners out there exactly what you need to know about the entity selection. Why is this so important for you? Well, I've worked with hundreds of business owners, and 9 out of 10 times, the thing that can save them the most amount of money over the course of their lifetime taxes is their entity selection. And that's exactly what we're going to be talking about. And if you don't have time to watch this entire YouTube video because you own a business and you're super busy, reach out in the comments below. I will reach out directly to you and answer any questions that you might have about your entity selection. We're going to be talking about in this video 4 key entities that are out there, how they're taxed, and the pros and cons to each one of them. We're going to start with the simplest and we're going to go to the most complex. Make sure you stay all the way to the end because the most complex entity structure can potentially help you avoid paying taxes on over $15 million of income. But you got to stay till the end to be able to find out. So why should you listen to me? Well, I've helped hundreds of business owners, and this is one of the most common problems I see with tax planning. The entity structure is set up wrong, and it's costing you tens of thousands of dollars in taxes every single year. And today, I'm going to show you exactly what you should be thinking about with the different types of entity structures that are out there. If we haven't had a chance to meet yet, my name is Luke Turner. I am the co-founder of Moen Private Wealth. We help business owners make smarter decisions with their money. If you're a business owner watching this video, you're going to want to subscribe to this channel because we're going to be putting out more and more content that is specific for people just like you. You're watching this video because you want to save tens of thousands of dollars in taxes. Well, in order to know how to save tens of thousands of dollars in taxes, first you need to understand what's costing you all this money in taxes. If you are set up as this entity structure, I can all but guarantee you you're overpaying in taxes. It is called a sole prop or a sole proprietorship. And there's 2 main problems with a sole proprietorship that you need to be aware of. Number 1 is self-employment taxes. Every dollar that you make as a sole proprietorship, you are going to have to pay 15.3% on top of your ordinary income bracket. Crazy to think, many people set their business up as a sole proprietorship and never change it and are paying all this extra money in self-employment taxes that they don't need to. And if you're set up as a sole proprietorship, you need to be aware of that. The second thing is that as a sole proprietor, you are much more likely to get audited because there is not 2 sides to the ledger. There's only what you're reporting on your tax return and your Schedule C. You do not have the reporting constraints that a partnership or an S corporation or a C corporation has. That can be really beneficial because it's very simple to set up, it's very easy to use, but you're more likely to get audited. So you're probably thinking, well, if there are all these negatives, why would anybody be set up that way? Well, it's easy. You set up your LLC, you open your bank account, the transactions flow in, you report that on your Schedule C, and you're done. For those of you that don't know, Schedule C is just where you actually report the income on your tax return. So if you're set up as a sole proprietorship, probably should think again. Well, let's move along here to the partnership. If you're just starting your business, I can all but guarantee you are an LLC taxed as a partnership. As a reminder, LLC is not how you get taxed. That's just for asset protection. You can make a tax election to be taxed as a partnership, which is what we're talking about here now. Our second entity. Why be set up as a partnership? You have a lot of flexibility. If you're set up as a partnership, here are the key things you need to be thinking about. Number 1, if you take a distribution out of a partnership, it doesn't have to be equal to the ownership. This is a big positive and why most of the times you get taxed as a partnership when you're first starting out. Let's say you have a business partner, one owns 25%, one owns 75%. If you take $100,000 out of the business, you could give $100,000 to one of the business owners. You could split it 50-50. You could split it however you want. Stick around because there's other entities that are out there that's not the case. So you have a lot of flexibility with a partnership. Another big benefit is depreciation in a partnership. Let's say that the business that you're starting out has a lot of capital that has to be deployed. So you're buying real estate, you're buying fixed assets, you're buying equipment, and you're able to depreciate that down. But in the first year of business, you have all this depreciation, but you don't have any income to offset it. This can be really positive for a partnership because you can use those losses to offset other income that you might have from other businesses. That isn't the case for all the other types of entities that are out there. So if you're just starting out, a partnership could be a really good option, but there's one big pitfall that you need to be aware of, which is as a partnership, you are also going to get hit with that self-employment tax across the board, just like a sole proprietorship. So you need to be very aware of that as you're thinking about the amount of money that you're planning on making, who's getting paid, and how they're getting paid. So if you're listening to this video and you're running a business and you're not just starting out now, but you're further down the path and you haven't made a tax selection change, this next step is probably for you. The third entity that's out there is called an S corporation. So as an S corporation, there are a couple key things you need to be thinking about. Number one is that as an S corporation, you can avoid almost all of those self-employment taxes. And here's exactly how. The special thing about an S corporation is that when you pay yourself a W-2 wage, you're gonna have to pay that self-employment tax. So 7.65 on the employer side, 7.65 on the employee side, added up to that 15.3%. But all your distributions avoid those self-employment taxes. And this can be incredible because you might be paying yourself $150,000, but taking $500,000 in distributions, and you're going to avoid that 15.3% tax across the board. Also, with an S corporation, you are going to be getting a 20% deduction on all of those distributions. It's called qualified business income deduction. And it's an amazing opportunity that you can take advantage of inside of your S corporation. So that $500,000 that you distributed out, the government allows you to deduct 20% of that right off the top. So that's $100,000 that you're not gonna pay taxes on right away. The biggest downside when we think about an S corporation are two things. Number one, when you do take those distributions, it's gotta be equal to the percentage of ownership in the business. So let's say that same example, you have a partner that owns 25%, you own 75%. If you take that $100,000 distribution, you have to pay $25,000 to the 25% owner, $75,000 to the 75% owner. And if you're thinking, well, how do I get around this? The only way to get around it is to pay an additional bonus through those W-2 wages. But you might be thinking that's going to be triggering more self-employment taxes. So making sure you're playing the tax game is understanding what your structure is, who the business partners are, and making sure you understand all these different components. The other big downside to an S corporation is that if you have a large amount of depreciation, you cannot go into negative basis. So in that same example I gave with the partnership, as an S corp, if you don't have profits to offset the depreciation that you're taking, those losses get suspended inside of your S corp. And you can't use those losses to offset other income that's outside of that S corporation. So making sure that you're aware of this is really important if you're just starting out in a business and you're going to have a large amount of depreciation, because you want to make sure that you can use those losses to offset other business income that you have in the event that your S corp never turns a profit. So you're listening to this S corp and you're thinking, well, this is definitely more complicated than a sole prop, a little bit more complicated than a partnership, but I've been waiting for the most complex where I can avoid paying tax on $15 million. And we are here at the fourth entity, which is the C corporation. The C corporation has one big caveat that we need to be very aware of, which is that we are going to have to pay taxes at the corporation level and at the personal level. So let's look at an example. Let's say your business makes $1 million in profit. You're going to get to pay taxes on that whole $1 million at the corporation level, 21%. You might be thinking that's a lot less than the top ordinary income bracket, which it is. Top bracket in the ordinary income, 37%. Top bracket on the corporate side, 21%. So there's this big tax arbitrage. You make $1 million, you only have to pay 21%. But the big caveat here is that if you take that money out of your business, then you also get taxed at the ordinary income rates. So for people that are looking to set up a C corporation, it's for those that want to leave the majority of their money in their business. And you might be thinking, Luke, what happens if I set myself up as a C corp, I want to leave all the money in the business, and then all of a sudden I need to pull some money out, but I want to pay taxes on it? The great thing about a C corp is you can take a loan from a C corp to avoid those taxes. But this starts getting very complex with intercompany loans. It's something that needs to be tracked thoroughly with your accounting and your bookkeeping to make sure that you stay compliant as a C corp. The other big benefit is that $15 million, which I know you've been hanging around waiting for. The way that this works is if you set up your C Corp, you can be structured as something called a qualified small business company, or QSBS. That qualified small business stock allows you, when you go to sell your C Corp, to not pay taxes on the first $15 million of capital gains. An amazing benefit. And a benefit you should be taking advantage of if you are building a company to scale and then potentially exit. If you want to learn more about QSBS and how you can avoid that $15 million in capital gain taxes, comment below QSBS. I'll personally reach out to you and share everything I know about QSBS. So that wraps up today's video and how you can be saving tens of thousands of dollars on your entity selection. If you're a business owner who enjoyed this content and you want to learn more about building real wealth, subscribe to this channel. We're going to be putting out more and more content just like this for business owners just like you.